Hello, everyone. Jeff Degner here from Prosperity Private Wealth in Morristown, New Jersey. I'm going to talk to you today a little bit about the health savings account. And it's a topic that comes up now and again when we're talking about other planning related items, but tends to get breezed over. And I'm going to kind of get into the weeds a little bit here. And I'm sure I'll teach you a few things that you may not already have known. The HSA account, although it looks and feels kind of like a retirement account, and many people associate it with an employer-sponsored plan, they think they need to work for an employer that offers a 401k and has an HSA. It's not the case. Some of the eligibility requirements we'll talk about here shortly, but it's actually a bank account that has a lot of characteristics that of a retirement account. And similar to the traditional IRA, the contributions that are made into an HSA, if you are deemed eligible, are tax deductible. So you can reduce them from your taxable income in that calendar year. Now, if an employer does match contributions into the plan, those contributions that the employer provides are not tax deductible. Similar to that of a Roth IRA, you get tax deferred growth, and distributions can be tax free if used for qualified medical expenses. They call this the triple tax advantage. So tax deductibility on the way in, tax deferred and tax free growth, and distributions are tax free if used for qualified medical expenses. Again, I talked about that triple tax advantage. Now, this money is yours. Again, it's a bank account that you contribute to in a specific calendar year, but it's not a use it or lose it scenario. That can be the case with other healthcare related savings vehicles like the FSA or the HRA. But no, this money is yours. And there is the ability to invest and grow the money. So if you do have an HSA, I would urge you to dig into that further. Many HSAs have a menu of investment options similar to that of a 401k, and you can set a threshold to keep a certain amount of your HSA in cash so that you're not liquidating investments to pay for healthcare expenses. And in a market like this, you don't really want to be liquidating investments. So we'll talk a little bit about the whole reimbursement aspect of it, because really there's no time limit on when you can reimburse yourself for healthcare related expenses. Meaning in a year like this, if you have, let's say, a procedure or a large costly item that qualifies for utilizing an HSA and having that payment be tax free on the way out, you might want to hold steady. Allow your investments within the HSA to recoup, grow tax free over time, and reimburse yourself down the road. Again, there's no time limit. And I will say that everything is subject to legislative change. However, we always stand on the side that you can't plan based off of the what if. You have to create a plan and operate based on, the current environment. And if there were any changes that do come about down the road, there likely would be notification and time allowed to submit for reimbursement or submit to recoup some of that tax-free growth. Eligibility requirements. Now, in HSA, you don't have to work for a specific company that offers the HSA. Really, it's participating within a high deductible healthcare plan, and not having a healthcare flex spending account, or having a plan that's associated with a healthcare flex spending account or healthcare reimbursement account. You also cannot be claimed as a dependent. So children, even though you may be out of college and in corporate America, if you choose to continue on your parents' healthcare plan and they do utilize you as a dependent, then you cannot make an HSA contribution. There is one thing here you'll see in the red: potentially a non-dependent child enrolled in a parent's qualified plan can make an HSA contribution. And I'll explain that further, as we move on. But contribution limits for 2022, $3,650 for an individual, and then a married couple can make a family contribution into one of the HSAs, one of the two spouses' HSAs of $7,300. Catch-up contribution, different than an IRA or Roth IRA. The catch-up is age 55 opposed to age 50. The catch-up amount is $1,000. Now, if an individual makes a family contribution of $7,300 and they're over the age of 55, they can put $8,300 into their HSA. They cannot put $9,300. However, the other spouse can set up their own HSA and make that $1,000 catch-up contribution. What that means is, again, $9,300. So both husband and wife, they cannot put both of their catch-ups into one HSA. An HSA is tied to an individual. Only that individual can make the family contribution and the catch-up. If the other spouse is tied to a high deductible plan, they can establish their own HSA and make a $1,000 catch-up contribution into that. So I explained what the contribution limits were in this calendar year. There is no income requirement like that of an IRA contribution or 401k contribution. Really, the main qualification is that you're tied to a qualified high deductible plan, healthcare plan. And we know that we're in a high inflationary environment, and we recently received notice that HSA contributions are due to increase, and it's actually one of the bigger increases that we've seen over the past couple of years. In typical environments, I've seen the HSA contribution increase by $50 or $100, but for individuals, the increase will be $200, and for families, $450. So $3,850 for an individual, family $7,750. In the same breath, I'll say, with the contribution limits increasing, also are the minimum deductible and maximum out-of-pocket cost. So it's definitely a consideration, but there's been a lot of movement and traction towards the high deductible healthcare plans. And when you really boil down the cost or expense incurred when compared to the other healthcare plans, the individual's cost for the premiums tends to be lower in more cases than not, and you have access to this investment vehicle that can be utilized for long-term tax-free growth. So I urge you to definitely look into it further, especially if a company is offering a match to the contribution into an HSA. So how much should I put into my HSA? In 2022, Fidelity estimated that approximately you may need $315,000 saved to cover healthcare expenses in retirement. Now, I've seen a number of different numbers depending on who you're talking to, and that's really on average. That's assuming kind of the norm, not the situation where you may need additional help or run into a prolonged healthcare expense. But this shows you down here, this chart, as compared to somebody that's investing into their HSA and maxing it out, yet not utilizing it for any expense. They're just letting that money grow over time. Maybe they're holding back their receipts and will submit for reimbursement later. But the difference between somebody who utilizes 50% of the contributions made is half, over the course of 32 years. So $965,000 all tax-free if used for qualified expenses relative to $500,000. Now, there always is the worry, may I or could I overfund my HSA account? Once you hit age 65, there's no penalty to take money out of your HSA. You can use your HSA to buy anything you want. And if it is a non-qualified expense, then you're just paying income tax on it, similar to that of an IRA. It basically becomes an IRA, and the distributions become taxable. Now, again, always subject to legislative change, but I mean, I would plan based on today. And if you're under 65, then the penalty becomes 20% on non-medical or non-qualified withdrawals. Planning considerations, this is always important. HSAs can help you bridge to Medicare. So you've got somebody who retires at 62, maybe they're using the company sponsored healthcare plan, retiree medical plan, and it's a high deductible plan. Well, they can use that to pay for their premiums. Or maybe they don't. Maybe they continue to make contributions in because they're still tied to a qualified plan. If they utilize Cobra, yes, they can continue to use that to cover premiums. However, private insurance does not qualify. It can also cover Medicare premiums. So Part B, Part D, which is prescription, it does not cover supplemental premiums, but yeah, Medicare Part B and D can be utilized in its fullest extent. Long-term care expenses. So somebody who has a long-term care policy, they can cover some or part of their premiums from their HSA. And the limit on what an individual can utilize from their HSA for the long-term healthcare premiums, it depends on their age. So as they get older, they can utilize more and more and more. So it's something to definitely consider, especially long-term care. You're basically locking in, you're locking in future long-term care costs based on today's rates. And again, I mentioned the risk is if you hit 65 and you do have a lot of money in your HSA, there's no penalty to take distributions and utilize it for everyday expenses. So it's a great tool to utilize, especially in this, high tax environment. Estate planning considerations. Spouse is a designated beneficiary, then the HSA is treated almost like an IRA, where the spouse can assume the HSA as if it's their own. If the spouse is not a designated beneficiary, then the individual who inherits the HSA or the named beneficiary has to take a full distribution, and it's viewed as income, taxable income to that individual. So as an estate planning tool, not the best tool to utilize, but I definitely, for somebody who maybe is holding back expenses for reimbursement, you would definitely want to reimburse yourself prior to death if you did have that, forward-looking view. Similar to that, if the beneficiary is the estate, then the estate would pay the income tax and the monies would be fully distributed before it was distributed to the heirs. Planning-based considerations. So there are a couple ideas I'm going to share with you, and some of which definitely, are going to be applicable to many. But I see people who have an HSA or they established an HSA and maybe they contributed the minimum amount to get the company match. Well, they may have a few HSAs out there. I would recommend consolidating them. You can go to a bank, open up an HSA. We even can open up HSAs for clients through Fidelity. And it's similar to that of a rollover, or a transfer. You can consolidate them into one. One-time IRA contribution. So if you have a small IRA, you can utilize your IRA to contribute to an HSA. Now you are bound to the limits or the annual limits, but if you have a small IRA for $6,000-7,000 and you want to utilize it to put those funds into an HSA, think of it almost like it's a pre-tax IRA. Think of it as like a Roth conversion without paying the income tax on it. After age 65, no penalty to withdraw money from an HSA. Again, that creates this sense of, definitely if you have the ability to put money in, you should do so. And if you have the ability to let that money grow and invest it tax-free and maybe pay out of pocket for some qualified expenses, but hold on to your receipts and, stay organized. Reimbursement rules. So you can reimburse yourself or you can reimburse yourself for any expense at any point, just as long as it was incurred after the HSA was established. So that's one consideration to keep in mind. Catch-up contribution. So if you're over the age of 50, it says 50, but over the age of 55, both spouses can make that $1,000 contribution. However, like I mentioned, the catch-up contribution cannot be made into one of the individual's plans, or I guess at least for both spouses. The one spouse can make a family contribution, their own catch-up, and then the other spouse would have to open up their own HSA, make a catch-up into that for $1,000. Non-dependent child. So this is what I referenced earlier on. You may have a child who's, I believe 25 is the only age that this would work for, but at the age of 25, a child is no longer deemed a dependent, and they still have the ability to participate in their parents' healthcare plan. So if your parents, or if your child is in that situation, age 25, just graduated college, but not a dependent from a tax perspective, you as parents can both make HSA contributions for yourselves. You can also maybe help a child open up an HSA and make a contribution on their behalf. You know, if they're younger, they're fresh out of college, you know, it's a good gift to give to a child to get that ball rolling in that direction and help them understand, you know, the benefits associated with an HSA. We have a few resources here. The IRS publication is something that talks specifically about HSA qualified expenses, what qualifies, what doesn't, and a Fidelity article, 5 ways that you can help yourself. 5 ways HSAs can help you with your retirement. These are all things we'll have available, and I appreciate everyone listening. Until next time, take care.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.